Welcome to the show. Back in the day, Wall Street was run by a very specific type of person. You know the type. The guys in suits, with expensive watches, and egos the size of small countries. This was the era of the Gordon Gekko and Jordan Belfort archetypes, where image and hustle were everything. For most of modern financial history, the process of investing with money managers and financial advisors was actually quite straightforward. You hired a person, and that person performed a series of traditional tasks. They read through company filings, they listened to every earnings call, and they analyzed trading multiples with serious expressions. But then, in many cases, that person ignored all of those data points because they had a hunch about a random biotech startup. It was a truly poetic system because sometimes these managers were right, but more often than not, they were wrong. At least it felt human. And that's because there was always a story involved. Whether that story was that the management looks strong, the balance sheet feels healthy, or even just a simple gut feeling that the stock feels cheap. If we're being honest, this whole era was essentially just astrology for men who wear cufflinks. For decades, crafting these narratives was the norm because markets were inefficient, data moved slowly, and actual information advantages existed for those in the room. It was truly the absolute peak of capitalism in financial markets. But then, something happened that changed the entire landscape of finance forever. The math nerds finally showed up. We're not talking about your average accountants. We're talking about guys named Yang with PhDs from Harvard, multiple math Olympiad medals, and dreams that consist exclusively of probability distributions. In the late 1980s, these nerds began to band together because they realized a fundamental truth. Markets weren't entirely random. They saw that statistical patterns exist. Human behavior repeats in cycles, and market inefficiencies constantly open doors for massive opportunities. This was the birth of what we now call quantitative investing. Instead of asking the traditional question, "Is this a good company?" the quants were asking something entirely different. Given these specific variables, what is the mathematically expected outcome? It was a shift toward rules over narratives, probabilities over opinions, and hard math over gut feelings. And man, did it work. Quantitative hedge funds began popping up out of nowhere like acne on a teenager, and the most infamous and successful of them all was Renaissance Technologies. More specifically, it was their flagship fund, the Medallion Fund. The Medallion Fund is widely considered to be the most successful investment vehicle in the entire history of finance, yet you've probably never even heard of it. It was founded by a brilliant mathematician named Jim Simons. Simons didn't believe in the old ways. He believed in using purely mathematical and statistical models to predict market movements. This meant no fundamental stock picking, no shouting on CNBC interviews, and no magic genies hiding inside a Bloomberg terminal. It was just purely math, advanced algorithms, and machine learning. The results were obscenely good. For more than 2 decades, the Medallion Fund generated over 60% annualized returns before fees and roughly 39% after fees. For context, the legendary Warren Buffett averaged around a 19% annualized return over his entire career. Let's look at the math. If you compounded $10,000 at Buffett's returns for 20 years, you'd end up with around $324,000. But if you had invested that same $10,000 with the Medallion Fund's returns, that money would have grown to a little over $7 million. The Medallion Fund transformed the industry because instead of humans making all the judgment calls, people leveraged systems that dynamically reacted to price movements, order flow, volatility, and countless other variables at speeds no human could compete with. While quant funds were becoming the favorite tool for institutions and high net worth individuals, something else was unraveling for the everyday investor. While a very small number of people truly do have the ability to outperform through discretionary stock picking, these people are very few and far between. By the early 2000s, the data proving this was starting to pile up. It turns out that these active fund managers, the guys who talk a big game, actually kind of stink at picking stocks. They don't just fail occasionally or during bad years, they fail consistently. Study after study showed that roughly 90% of active equity fund managers underperformed their benchmark over long periods, and when you consider the high fees they take for managing your money, the situation is even worse. Investors finally began asking the obvious question: why am I paying extra to underperform? This realization is where index investing entered the story. It's low cost, it's passive, and it's designed to replicate the entire market's performance rather than beat it. Instead of searching for the needle in the haystack, investors simply began buying the whole haystack. The traditional stock-picking money manager role was slowly becoming obsolete. As retail investors moved toward index funds and ETFs, institutions did something similar, reallocating capital away from traditional active managers toward alternatives like quant firms and private markets. Careers evaporated as capital flowed out of the old industry. However, there was still a demand for the boring stuff of portfolio management, benefits like rebalancing, asset allocation, and tax optimization. That's where we are today and where robo-advisors come into the story. But we need to clarify something. If you hear that robo-advisors use algorithms, you're right, but it is not the same as a quant fund. Quantitative hedge funds like Renaissance Technologies or Two Sigma use algorithms to exploit microsecond market inefficiencies and statistical arbitrage in pursuit of alpha. Comparing a quant firm to a robo-advisor is like comparing a Michelin star chef to Chef Boyardee. Robo-advisors are essentially just automated platforms designed to deliver low-cost market returns with minimal human involvement. They aren't trying to compete with quants, they're trying to replace the manager while handling the busy work your financial advisor would charge you 1% a year to do in Excel. And investors love it. Platforms like Wealthfront grew from $2 billion in assets to $80 billion in just 10 years. Globally, robo-advisors managed nearly $2.8 trillion by 2023, and that's estimated to reach $4.7 trillion by 2027. Before we dive into the blatant issues with robo-advisors, a quick pause for our sponsor, Surfshark. Surfshark is a VPN service built for people who don't want to constantly manage their privacy online. With Surfshark, you just turn it on and your internet traffic is encrypted, your IP is hidden, and your data stays private. The best part, you can use one account on unlimited devices simultaneously. It also comes with features like an email scam checker to help detect phishing attempts and protect your personal information. If your data does ever show up in a breach, Surfshark Alert notifies you right away. It's an all-in-one solution for online privacy, whether you're working from home or traveling abroad. They are so confident in their service, they offer a 30-day money-back guarantee. Check out the link in the description or use the code on the screen to get 4 extra months of Surfshark VPN. Now, back to the issues with robo-advisors that nobody seems to be talking about. On the surface, robo-advisors sell personalized investment solutions. But while they feel like a sophisticated, tailor-made solution, they are nowhere near as personalized as they appear. It starts with a questionnaire covering your age, income, and goals. It feels intentional and crafted for you, but in reality, you're just categorized into a bucket and slotted into a model portfolio shared by thousands of others with similar answers. They aren't hyper-intelligent AI, they're just operational replacements for a guy named Gary who used to explain beta with a laser pointer. For decades, financial advisors weren't really paid for outperforming, they were paid for access to markets, products, and information. That made sense when markets were opaque and data was expensive, making investing feel like trying to assemble IKEA furniture without instructions. But then the internet showed up. Information asymmetry disappeared, market data became free, and research tools went mainstream. Suddenly, advisors weren't guarding the dates anymore, and paying 1% a year started to feel questionable. Travel agents disappeared because booking a flight stopped requiring a phone call. Stockbrokers disappeared because clicking a button was faster than calling a guy named Rick. Whenever access becomes free, the middleman gets replaced by technology. This isn't about being good or bad, it's about what happens when technology forces fundamental changes in a stagnant industry.